we all know there's pretty much four major trading sessions, and it starts with the Sydney session at the start of Asia, which leads into the Tokyo session, which is the major Asian or major session for Asia. Then coming into the London session, which obviously is the bulk of the European session, and then leading last but not least into the New York North American session. Now, what you have to understand is each session is unique and has its own liquidity and volatility characteristics, very much like the currencies themselves. Okay, so, but just looking at the various time zones and looking at what percentages go through these. So the Sydney session itself is quite small. There's a small overlap between the end of the New York session and the start of the Japanese market, which is the predominant market in Asia. Now, that Sydney session equates to 4% of all Forex turnover. Then that sort of rolls into the major session in Asia, which is the Japanese session, which equates to 6%. Then you've got the European session there at 37%, the North American session with 18% of FX volume turnover. So the remaining percentages there obviously sort of made up with all the peripheral markets. Now, this is going to be a sort of key part to understanding the sessions and why it's important to understand the sessions themselves. Now, the Sydney session as well, just looking at this, as I mentioned, 4% of all FX market turnover. Generally pretty low liquidity and at times extreme volatility. You know, the twilight zone, as it used to be called back in the day, where the New York market shut and before the major Asian session started, the Sydney market was a bit of a stop-loss sort of hunting area. At the moment, it's a bit more of a solid time zone. There's a lot more volume going through the Aussie dollar itself. And the most actively traded currency pairs will be driven by news and data released during that session, namely the New Zealand dollar, Australian and Japanese data. So this is one of the key parts that you have to understand when we start talking about the importance of each time zone. The traders in each time zone actually trade what's in their pockets. Okay, so the Japanese session, for instance, the Japanese traders are more interested in trading the yen and all the yen crosses than anything else. Now, this is the major session for Asia. It only has 6% of all FX market turnovers. Now, liquidity in this session can often vary dramatically in this market. Okay, and the most actively traded currency pairs are obviously coming out from the actual country that's open. Okay, namely the Japanese yen, and the major crosses during this session which are active are Euro yen, Aussie yen, Kiwi yen, Sterling yen, and CAD yen. Okay, anything with the yen in it is going to be extremely active during that Asian session. Now, the London session, which is the sort of headquarters, I guess, for the European session, it has 37% of all FX market turnover, good liquidity, and less volatile conditions. Okay, this is the premier market for the FX markets. You know, the major focus are Euro and Sterling. Okay, they are the currencies. And also, I guess you would also include the Swiss, but the Swissy generally follows the Euro. The Euro doesn't necessarily follow the Swiss. So when you're considering that, Euro and Sterling are the major focus for the currencies, but also looking at those currency pairs and those crosses which are active at that time, Euro Sterling, Euro Swiss, and Sterling Swiss, and also probably Euro Yen as well. Now, what you have to understand is with this time zone, it can often be difficult to trade on a large number of political announcements as the various European countries like to counter each other. Now, we found this during the GFC. When you actually are coming into the European session itself, if there's any heightened political tension, it's actually a much more difficult session to trade, primarily because the finance ministers for different countries will generally counter each other's comments. You know, there's a lot of animosity at the moment across Europe with regards who should be in the euro and who should be out. And that's what became clearly evident during the GFC, during sort of 08, in particular, where, you know, a lot of the political announcements will make it almost untradeable to trade during that session. Now, the New York or North American session, it has also a high level of activity with 18% of all FX market turnover, good liquidity, and once again, less volatile conditions. But the most important part about the US session is since the US dollar is the benchmark for most traded pairs it is critical you're aware of upcoming releases. Okay, so what we can see is large one-way moves in the US dollar on economic data and political announcements. And because the US dollar is the benchmark for just about every currency pair globally, this is the session which has potentially the biggest impact across the board. Okay, and that's why we sort of should know that. Now, as far as looking at the hidden danger zones for the actual trading week, what you should be very aware of is the Monday open and the Friday close. Okay, so the Monday open in Asia, it starts with Sydney at 5 a.m. Sydney time. There's low levels of liquidity, high levels of volatility, and what you have to factor in, or the markets, and why that is so, because markets are susceptible to weekend news events. Generally, G20s are organised on the weekends. There's also, in this day and age, the 2-day event risk, where there's it's possible that we may see some terrorism or the like, which will impact the economic or the currencies very dramatically on the open. And a lot of these Chinese data is actually being released over the weekends as well. They're changing interest rates. It is impacting the currencies dramatically on the open. So this is one of the key reasons why we don't have run positions over the weekends. If you do have a long-term position on, generally we're closing it out Friday and replacing the order on Monday, sort of after a good few hours of the market being open. Now, the Friday close is very similar. Once again, low levels of liquidity, high levels of volatility. As I said, the G20s are on the weekends. You can sort of get some sort of harsh moves in the currencies coming up to the end. The 5 p.m. close in New York. Don't forget, when we hit 5 p.m. New York, Asia's already hit the weekend. The European week's over. They're already sort of switching off for the weekend as well. And you can often be left. I mean, after working in New York, I can tell you most senior traders are out of there by 2 or 3 p.m. in the afternoon. So you do find there's less liquidity at these times. So what times are we looking at? So Monday in Asia, generally what you're looking at is somewhere between 5 and sort of 10 a.m. Australian Eastern Standard Time. You would be sort of staying away from the markets, particularly from 3 p.m. in New York on Friday to the close. I wouldn't be sort of looking to get into trades anywhere around that time. And that's one thing we will be looking at.